Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got an incredible show for you today. Make sure you do send your questions to Brian Rezny at ReznyWealth.com. And as always, if you want to visit our website, ReznyWealth.com, you can send them for instant email alerts about the economy, the markets, and general ideas about finance, really to better your financial situation. You know, today's topic, I want to talk a little bit really about mediocre investment advice or mediocre advice in general when it comes to your finances. Too often, I find investors, the advice they receive is advice more of sales and really almost propaganda and junk than any real advice at all. The sad fact is the majority of advisors, which is really a fancy title for salespeople, really are selling inferior products, whether it's insurance products, annuities, investments, maybe mortgages, maybe long-term care insurance, but inferior products they're required to sell with higher cost structures that ultimately come against you and your money. What I find though is investors, even though they may realize over a period of time the relationship they have is really not a good relationship and it's not suiting them well, they'll still procrastinate. They'll put up with mediocre advice for far, far too long. As an investor, when you realize things don't seem right, you need to find a real firm to help manage your wealth, because the longer you wait, the more financial security it costs you and the more dollars you ultimately leave on the table. Conflicts, being sold inferior investments that rob your returns in your retirement. Let me tell you a quick story. We had a newer client a few years back that came into our firm, and unfortunately they visited one of these annuity people that sold these equity index annuities through a free steak dinner seminar. They put $2 million in these equity index annuities. When they came to see me 3 years later, the annuities that they were promised that would make 7% returns and would not have expenses, these people actually lost money over 3 years because of the expenses, meaning their $2 million was worth less. And they weren't making any return, of course, on their money, so they actually had to spend principal out of the annuities. So in 3 years, their $2 million is worth like $1.7 million. Because they were sold inferior annuities that they thought were magically really good, because the salesperson that was selling them called himself an advisor and was an attorney and was an insurance salesman. And what they realized after 3 years, if they keep going in this path, guess what? They were going to be broke in maybe 10 or 15 years in retirement, and nobody wants to end up another greeter at the department store when you're 75 or 80 years old. Let's face it. Procrastination is costing your wealth and your financial security. You could wait till tomorrow. Hey, we got a big vacation coming up, or the holidays, or whatever it happens to be. People always want to wait. But the longer you wait, again, it costs you quite a bit of money. Not only return, but lost opportunity, maybe higher taxes, and so on. As an investor, I try to urge every investor, the sooner you handle and fix the financial problems or the bad advice you're getting, the better off you're ultimately going to be. If you do hire a firm to manage your wealth, only hire a real money management firm. Remember I mentioned earlier, an advisor is really just a salesperson. Some of these big Wall Street firms call their people wealth managers. They're not managing any wealth at all. The only kind of firm you should entrust your money to is a real money management firm. That would be a fee-only fiduciary money manager like Rezny Wealth Management. Again, fee-only, not fee-based, but fee-only. The only kind of firm that works legally for you and manages your money would be a fee-only fiduciary money management type firm. Never hire an advisor / salesperson. Don't hire one of these wealth managers, because again, it's a fancy title for I'm going to sell you what my firm requires me to sell that isn't what is best for you. Never settle, never put up with conflicts either. You've worked too hard for your money. 90%, our estimation, the banks, the insurance companies, these brokerage firms, they're full of conflicts of interest that work against your hard-earned money. Conflicts do not belong in your investment relationship. But unfortunately, too many of you put up with these conflicts. Maybe because you don't know about the conflicts, maybe you don't know about the added cost of these conflicts, but ultimately conflicts are going to cost you financial security and hard-earned returns you should be getting that you work so hard for your money all the years up until you started investing. I'm going to go to some questions. So again, as always, if you have a question about your portfolio or a financial concern, send those to Brian Rezny at ReznyWealth.com, and make sure you do visit our website, ReznyWealth.com, for times availability not only of our TV shows, but my live radio show on Sundays, and also to sign up for any instant email alerts that we send out throughout the week. My first question comes from Kim in Naples, Florida. I'm starting to realize our financial advisor is really a salesman. How can one find a real advisor who works for us and manages our investments? That's a great question. The first thing I'm going to suggest is if you do go to ReznyWealth.com and you scroll down to the bottom of our homepage, you can download Real Advisor or Fake Advisor. It's a free report. It'll discuss how to actually interview a firm, how to know what firms are real money managers, which firms are sales organizations. We also give you the FINRA and the SEC site so you can actually check out the firm if they've ever had misdoings against their clients. But what you really want, Kim, is you want to find yourself a fee-only fiduciary money management firm. Anything other than that would be a sales organization with advisors who are really selling products they are required to sell that pay the highest commission, highest fees, have a lot of embedded conflicts of interest that ultimately, Kim, work against you and your money. I told the story earlier about a couple that came with a few $1 million that were sold a whole bunch of annuities. That didn't work out for them, but they were smart enough to realize things were going in the wrong direction, so they looked for that second opinion and they looked for a real firm like Rezny Wealth Management. Folks, I'm going to take a quick break. Go to ReznyWealth.com, check out our website. I'll be right back with more questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not fee-only fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 Investment Risks You Must Avoid Now. I'm back, and hopefully you're enjoying today's program. I know we're getting a lot of questions that are coming in. You can send your questions to Brian Rezny at ReznyWealth.com. You know, I want to go to Will in Fort Myers, Florida. What is ex-dividend date for stocks, mutual funds, or an ETF? That's a great question. All that an ex-dividend date means is the date that if you own that stock or ETF or mutual fund, you will get paid ultimately that dividend. So let's say a company announces they're going to go ex-dividend on the 15th, a couple days from now. If you own those shares before it goes ex-dividend, you actually receive that dividend. Now, it's not a plus or a minus necessarily to buy it on the date of ex-dividend, because remember, when they pay the dividend, it actually takes away from the share price itself, and you actually may pay a tax on a dividend, but actually have a lower price ultimately on the stock that you own that you don't really realize is what's happening. So ex-dividends are not a plus or a minus, but again, once it hits ex-dividend, if you own it on that date or before, you ultimately will get that dividend paid to you. And most companies, ETFs or mutual funds, will pay quarterly, semi-annual, or it could be an annual type dividend. It just depends on the actual vehicle itself. Betty in Dearborn, Michigan. If I only have a small amount of money to invest, is it even worth it? Betty, if you have $1 or you have $1 million, the sooner you start investing wisely and putting that money to work in the right place, the better off you're going to be in 5 or 10 years. Everybody starts off small, but the sooner you start off small, the sooner you can become wealthy and really financial independent. So what I'm going to suggest is this. If you can start out with $50 or $100 and you can add to that investment account monthly, semi-annually, whatever is good for you, you're going to be that much better off. Remember, the key to making wealth is not winning the lotto, because most people are never going to do that. The key to creating wealth is systematic adding to your investment account. Even if you start small and the amount you add are small, in 5 or 10 years, you might find that $100 you started with could be $100,000 in 10 years from additions and actual return of that investment. Kent in Naples, Florida. Stocks versus bonds. How to choose the best investment for my $1.2 million portfolio. Kent, I think what you're asking me is, should you own stocks versus bonds or bonds versus stocks? So let me explain how Rezny Wealth Management works. We're an active money manager. So we don't believe in just investing in stocks or bonds or the combination of the two. It depends on the current cycle we're in. It depends on the risk profile of the actual investor that we're working with. So we're, as an active money manager, there's times we own a lot less bonds, and there's times we can own a little bit more bonds. There's times in our growth portfolio that we own all equities or stocks in that portfolio, and there's times we might trim some of those positions. So it really has to do with really the macro, the big macro events around the U.S. economy or whatever economy you're looking at to see how that economy is doing and is projected to do over, let's say, the next 1 to 3 years. So based upon where we see growth or contraction, that's really going to dictate how we're going to invest client money. And again, making adjustments to portfolios as things change over time is vitally important. Unfortunately, what I find, Kent, is most people have more of a set it and forget it asset allocation, which in our opinion is a huge mistake. Let me talk about a quick story. A client that we had about 4 years ago that hired my firm. They were at one of the big banks. They had maybe about $800,000 in about 6 different accounts, whether it was a Roth account, an IRA account. What was interesting, their Roth accounts had about $30,000 in them, but they had almost 80 different investments in that $30,000 account, because the bank believed in what's called asset allocation. Spread the money everywhere, so you own a little bit of everything at the buffet, but then it doesn't taste so good, does it? So the key to investing is not asset allocation, which is what most of the banks, insurance companies, and brokerage firms really push on you investors. It's really a defined portfolio of quality investments that are appropriate for today's investing environment. So asset allocation, in our opinion, isn't good, but defined investments in areas that truly can produce or have the ability to produce the returns you're looking for is always vitally important. Carl in Naples, Florida. Will such high inflation, which now seems likely to continue at least into early months of 2022, damage stock prices? Carl, generally speaking, inflation is high, and there are parts of this inflation that are going to be around forever, and there are parts that will kind of abate over time. But inflation is not crazy high like we saw back in Jimmy Carter days. We don't have really high double-digit inflation across the board, but there are parts that are much higher than normal. So some inflation will actually help the overall equity markets. Real high inflation could slow it down and put us in a recession. But generally speaking, the inflation we're currently seeing is manageable, but there's areas of the overall investment markets that actually will do quite well with inflation. And one of those that I talked about earlier last year was oil. Oil was a great inflation hedge, and I continue to see oil, fair disclosure, we do own oil in our client managed accounts. I still see oil as an opportunity as we continue to go into 2022. Dean in Punta Gorda, Florida. Are alternative investments like angel investing or cryptocurrencies a good idea? Generally speaking, when I hear the word alternative investments, Dean, I run away. Alternative investments are basically manufactured by Wall Street and brokerage style firms in order to basically harvest even higher fees from you, the client. I don't like cryptocurrency. It's a speculation trade. We do not speculate as a money manager. I think a lot of people are buying into crypto, have no idea what they're buying into, but they're chasing past returns. So before you buy any alternative investment, whether it's one of these hedge funds, direct participation programs, maybe cryptocurrency, and there's a lot of other alternatives out there, make sure you understand. Alternative usually means speculation. It means higher risk, and it ultimately means you could lose all of your money in that investment. My opinion, you should never speculate with your money. You should only invest in quality investments that have the ability to generate growth and income and make money slowly over time. Instead of thinking you're going to get rich, maybe have a lucky hit for a month or two, but then lose it all at the casino table the next day. Never a good idea. I'm going to go take a quick break. As always, visit our website, ReznyWealth.com. Check out our consultation tab. We do manage larger portfolios of $1 million and greater. If you're realizing the firm you utilize is not a fee-only fiduciary money manager, your returns have been lackluster, your service has been lousy, it's probably time you look at Rezny Wealth Management. Positive difference when you hire a real firm to manage your wealth. Go to ReznyWealth.com, click on any of our tabs, but especially for you larger investors, click on our consultation tab. We'd love to talk to you about managing your wealth and making sure you're well taken care of at Rezny Wealth Management. We'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. And we're back. I hope you're enjoying today's program. As always, send your questions to Brian Rezny at ReznyWealth.com. You know, just before the break, I was talking about asset allocation, and I know I get a lot of questions on this. So asset allocation, think about this. When you were a child in school, remember most kids had like the 8 box of crayons? But there was always that one child that had the 96 box of crayons. Think about coloring a picture and pulling all 96 crayons out and using every color on a picture. It's not going to look that good. Asset allocation that is pushed by a lot of these Wall Street firms and banks is kind of like using the 96 box of crayons. They own a lot of everything. Some stuff's appropriate, some stuff is not. The good stuff does good. The bad stuff doesn't do great, but it waters down the overall portfolio. So you ultimately don't really get higher returns. Often what we see with asset allocation, you probably make less money, and you actually amplify the risk based upon a lot of the other alternative investments we often see in some of these brokerage accounts, banks, or insurance companies. So watch out and be wise when it comes to asset allocation. It probably hasn't treated you so well, and it probably won't in the future. Bill in Naples, what is your advice to clients about long-term care insurance? My wife and I are already retired in our mid-60s. Bill, in general, I am not a fan, and I do not believe in long-term care insurance. You could buy all kinds of insurances and basically break yourself financially and make the insurance companies rich. So let me give you a statistic. I've been managing money for over 30 years. I've dealt with hundreds, if not thousands, of clients over that time frame. I can count on one hand how many of my clients went into a nursing home for more than a couple months. The insurance companies will give you some crazy statistics, how you're going to end up in a nursing home for 5 years and you're going to be broke. I will tell you factually, I never have seen that. So what I'm going to say is this. The people that can afford long-term care insurance can afford to go to a nursing home for 3 or 4 or 5 months. It's not going to break the bank. Most people today, if you're going to a nursing home, it's because you're at end-of-life care, so you're not going to probably live very long anyway. If you're sickly and you need some help, most people will do in-home health care today, which is actually very reasonable and very manageable, and most people would rather stay in their home if possible. So I do not like long-term care. I do not recommend people get long-term care. But again, read the fine print and look at how much you're going to pay for limited benefits. If you invest that money wisely, when it comes time for you to go maybe to a nursing home or assisted living, you'll have a bigger portfolio that you can actually utilize instead of, again, getting limited benefits and making the insurance company rich. Jim in Naperville, Illinois. Where should I invest if I'm brand new to investing? Jim, one of the, in our opinion, one of the best investment vehicles to utilize as an investor is something called an ETF, an exchange traded fund. ETFs are kind of like a stock, but an ETF owns multiple stocks or investments in one basket. So you could buy an ETF that owns the S&P 500. That's 500 stocks. You could buy a basket of long-term treasuries in an ETF form that owns a whole bunch of different government treasuries. So there's all kinds of asset categories within the ETF format. What's nice about it is you can be diversified at a very low cost, and you can build out a quality portfolio that's properly diversified, but not dumb diversification like I would consider asset allocation, but smart diversification. And utilizing ETFs is a great opportunity to build a quality portfolio. And it's something that a lot of investors, I think, overlook. And probably because their so-called advisors at the bank or brokerage firm don't really want you in those. They want you in things more complicated that maybe line their pocket just a little bit more and yours a little bit less. Let's go to Cliff in Fort Myers. KLAC, Microsoft, and Texas Instruments have all had wild swings over the past several months. Is this a result of day traders? I want to thank you for keeping me calm this year. Hope I survive the next 3. Cliff, thanks for the nice comments. Generally speaking, those stocks or any stock really are not going to get swung around and have volatility because of day traders, especially when you're dealing with large cap companies like the ones you cite. Day traders usually will go after smaller companies, micro-cap companies. They could sway some of the volatility there, but big companies like Microsoft, they don't have enough purchasing power to really swing those markets. So what you're seeing is this. Every asset category, whether it's stocks, bonds, whether it's gold or real estate or oil, they're all going to have some form of volatility. That's the nature of the beast. So what you have to realize as an investor is make sure that the volatility that is acceptable to you is built within your strategy on how you diversify that portfolio out. The companies that you cite, generally speaking, I like most of them. But again, don't overload the boat. And what you might be doing, unfortunately, Cliff, is you maybe own too big of an allocation to some of these stocks. As a rule of thumb, if you're more of an aggressive growth investor, never own more than 5% of any one individual stock. And as you approach or get over that percentage, you should be trimming exposure and diversifying out. Owning too much of one stock, regardless how great it is or how great it did, or how great you think it's going to do, could be a recipe for disaster if that stock goes in the wrong direction. Todd in Cape Coral, Florida. Should I invest a cash windfall or use that extra money to pay down debt? Todd, that's a great question. So think about it this way. If you just inherited a bunch of money, the first thing you should do is say, do I have any crazy expensive debt obligations that I should pay off? So as an example, you've got a $20,000 credit card bill and you're paying 24%. Yes, you should pay that off for sure. But let's say you have a mortgage of $150,000 and you've got a 3% interest rate on that. So after your tax deduction, it costs you 2.5%. I would keep that mortgage. That's cheap money long term, and then invest that windfall properly for the long term. So again, pay off expensive debt. If you don't have any expensive debt, then clearly diversify that portfolio, invest it wisely. You've got a house, you've got a portfolio, you could potentially be in great position in the next 10, 15 years for a retirement. Joan in Naples, Florida. Should I tweak my investment strategy as I age? You know, Joan, what happens is this. Age has nothing to do with whether or not you should be more conservative or more aggressive. So whether you're 30 years old or whether you're 80 years old, age has nothing to do with how you should allocate your money and the risk profile you should be. Unfortunately, a lot of the Wall Street firms love to push what's called an age-based approach. Just because you're 70, they think you should be hiding in a closet. That's not the case. Now, there's some 70 years old that are really conservative. Then you should have a conservative portfolio. But there's a lot of 70-year-old people that can handle normal volatility. You know, not that they like when their portfolio drops 10% when we have a correction, but it's like they can handle it. They're not emotional, but they're looking for that long-term growth of a growth portfolio. That person, in our opinion, is going to do ultimately better the next 3 to 5 years than the 70-year-old person who's very scared and nervous and has too conservative of a portfolio. So age has nothing to do with it. If you're retired now and you haven't really changed your risk profile, then keep it the same. Invest wisely. Grow that money. You can always sell growth off for income. So unfortunately, a lot of people get too conservative in retirement. Maybe you should be more balanced or growth in retirement. It all depends on your upstairs emotional attitude is really what you need to look at. Tim in Cape Coral, Florida. Should I invest in stocks, but I'm nervous about the markets? Should I be? Tim, generally speaking, is this. If you're nervous about the markets, meaning you're nervous about your money going up and down, maybe stocks aren't for you. If you're not nervous about your money going up and down, remember, nobody likes when their money drops temporarily. Nobody likes that. But some people can handle that volatility better than others. I've talked to hundreds of investors over the years where they were really conservative. If their $1 million ever dropped to $990,000, they'd be like, oh my gosh, I'm going to jump off, the second story. That person should probably stay at the bank and put it in a CD because they can't handle a little bit of volatility, and that's not a lot. So what I would say to you is this. You need to come together with your inner self and really look at what you're comfortable with. Maybe it's not an all equity or stock portfolio. Maybe it's a combination portfolio that will basically have a little less volatility. Remember, you're never going to get rid of volatility if you want to make a return on your money. The more conservative you get, the less money you make. And just because you get more conservative doesn't mean you get rid of volatility. It may come down a little bit, but you're still going to have some of that. But remember, over the next 5 or 10 or 15 years, even if you're 65 and you have volatility, well, you're not spending all your money in the next 3 years, are you? No. You're going to spend a little bit each year over your retirement lifetime. And for somebody 65 or 70 is at least 20 years or more. So again, think about that before you do the wrong thing with your money and maybe get too conservative. As always, I love the questions. One of the things I want to stress to every one of you investors, never settle for bad advice. If you're realizing the advice you've gotten for years or decades is just not really working, and you're realizing the overall service you're getting is really not money management, but more of sales, and you're tired of conflicts, bad advice that really undermine your financial security, then it's time to look for a real firm. Remember, fee-only fiduciary money management. I've been managing money for over 30 years. We love helping pre-retires and retirees get back on track and make sure you're well informed about your money. So don't settle for a so-called advisor. Do what's right for your money. Do what's right for your financial security. Go to ReznyWealth.com, check out our consultation tab, or better yet, call us during the week. We'd love to talk to you about your portfolio and make sure we get you back on track and make you happy again with your portfolio and your retirement. Have a safe and prosperous day.